Hello and welcome to The Resilient Investor with me, David Stevenson. We look at the kind of basics of investing in all of these episodes, and we try and work our way around all the lingo and the technical jargon that gets thrown around in the world of investing, so that at the end of it you begin to understand the language and the ideas and the strategies, and then can build them into a slightly more resilient strategy for investing for the long term. So in pursuit of that noble, lofty goal, which isn't always achieved, I have to admit, we like to sort of talk about terms like equity income and growth, and particularly when they apply to things like equities, stocks, shares to you and I. And so you might hear quite a lot about when people talk about the importance of dividends and income and growth. And we're going to dwell a bit on that in this episode. And I've got absolutely the right person to talk about that with me, James Harries, who's the manager at the STS Global Income and Growth Trust. James, welcome.
Thanks very much.
The clue's in the title, income and growth. So we might come back to this whole idea of this growth and income. Is it a face-off? Is it a bit of both? Is it a blend of both? We'll come back to that idea. That do you forsake growth for income?
Okay.
But let's hold that thought for a minute. And let's go back to basics and start with this idea about, we quite often hear this term equity income bandied around. Yeah. And obviously equity are stocks, are shares, and many shares pay a dividend. Now, a lot of people might regard that, particularly in the age of Nvidia, where it goes up 86 billion times in the short period of time, as dividends, a bit old-fashioned, really. Why would you care about that? And equity income gets to the core of that, doesn't it? Yeah. It sort of says dividends matter. Could you just explain what equity income is and whether or not it's a useful term?
Yeah, okay. So let's break that down into both equities and income. Equities, as you very well know, are merely a small proportion of a bigger business. They give you ownership in a business, and therefore you're entitled to the ongoing cash flows, dividends, the ongoing success of that enterprise. And as you correctly say, some businesses pay a dividend and some don't. Yeah. Now, the reason that's important to us is because our investment objective is to produce both an income and capital return. And I think why that's important is because to a certain cohort of investors, having income actually is quite beneficial. Yeah. Now, I always think the best investment strategies, or investment trusts maybe, are those that solve a problem for someone. Yep. And what we're trying to do is, often our core client base are those who have irreplaceable capital, often therefore not working, and have a sort of
by irreplaceable, you might mean they're retired.
A fixed pool of capital.
Yeah, fixed pool of capital.
And in need of income. And the reason I think that's important is because the split between income and capital goes back to the Crusades. Yeah. It goes back to a time when you were entitled to the income from an estate, but you weren't entitled to the estate itself. And therefore, it's a very ancient concept. So maybe old-fashioned, but I would say actually pretty ancient. Yeah. And the way I think about this is if you have an irreplaceable pool of capital, then, and particularly if you're not quite as young as once you were, then income's quite valuable because you want to be producing just a return, because that obviously grows your capital and protects you from inflation and so on. But it also is doing something for you. It enables you to pay your day-to-day bills and protects your long-term well-being. Now, the reason income is important is because when you're young, volatility is your friend. Yep. Because if things go really badly, you've got plenty of time for things to come right. And in fact, if the market halves, that's a good thing because you can buy equities cheaply. When you're older, you should seek to avoid large drawdowns because that's very damaging, because to not put too fine a point on it, you haven't got time for the capital to recover. Similarly, if you pay your day-to-day bills from income, you can leave your capital to compound without touching it. And what that means is if the market halves, and we all know that can happen, then you don't have to dip into your pool of capital at a point when you really don't want to in order to pay your day-to-day expenditure. Yep. So although it is an old-fashioned concept, it does actually, we think, have a relevance to real people and what they're trying to achieve with their money at a particular point in time in their lives.
Now, I also want to differentiate here between income as an objective for the investor and income as an indicator of a corporate success or the attractiveness of a share as well, because that's relevant here as well, isn't it? It's quite noticeable that some of the most successful long-term investors, everybody talks about people like Warren Buffett and that kind of stuff, and we'll come back to this argument of another term you quite often hear used, quality. Quality stocks, quality companies. But you look at it and actually look at all the long-term studies and look at what Warren Buffett's done, and this idea of kind of compounding the dividend you get and then reinvesting, that's another element, isn't it? And then there's another element that sits beyond that, isn't there? So it's great you get an income paid, and that serves a functional purpose for the investor. it's great that you can take the dividend and reinvest it. And again, we'll come back to that. But there's also people who say actually companies that are more dividend orientated. So actually, NVIDIA does pay a dividend, but
not much.
Not much. Yeah, exactly. Yeah, very low yield. But companies that don't pay a dividend, and we'll come back again to this idea of growth. People sometimes worry that they can be the wrong kind of stocks. So that dividends is a signalling device, isn't it? Or it can be that the corporate management is putting your interests at the centre of what you do. So there's those three different ways that dividend matters, isn't there? Which is the most important to you?
Well, there's an awful lot in that question.
Yeah.
And let me try and once again break it down a little bit. So some companies choose to pay a dividend, some don't. And to our mind, companies that pay a regular cash dividend, that actually has a beneficial effect on the way the business is managed itself.
Yeah.
It's not simply because it's desirable to shareholders. It's because if you pay a dividend, then you have to generate cash to pay that dividend, which means you're actually generating cash flow, not just earnings.
Which means you'll be very focused on cash, not marking up all sorts of weird accounting tricks.
Correct. It also means that there's academic literature to show that companies that pay dividends are more careful with the capital which they retain, whereas if you don't pay a dividend, you tend to go off and do all sorts of things with the capital and spend it sort of willy-nilly, so to speak. And thirdly, you could argue that a dividend is quite an interesting or quite an accurate representation of what a management team believes a sustainable mid-cycle earnings number or proportion thereof of a business is.
What do you mean by that?
What I mean is if a company is generating 8% return, then if the management teams it pays you a 3.5% dividend, say, then what they're saying to you is that we think it's not just going to earn 8% this year, but we're pretty confident that it's going to earn 8% year on year on year on year, because we're comfortable that we can spend 3.5 of that giving it back to you and manage the business thereafter.
And so just to dwell on that point, because one of the debates you quite often end up with, if I got an academic economist in here, they'd probably go, dividends was a terrible idea, because really what you should do, dividends are just, you should just take all the earnings of the business and reinvest it back in the business. How would you respond to if it got, because that's quite a strain of academic thinking.
Yeah, so what I mentioned, there is a piece of academic literature which basically says that there is a positive correlation between the payout ratio, i.e. how much money you spend, you deliver in terms of dividend, and the growth you deliver thereafter. And actually, if you're more careful with the capital you retain, then you do a better job with it. There is also it's Miller and Modigliani, effectively. It's the irrelevance theory.
These are very famous economists.
Indeed.
If you really want to bore somebody at the dinner party, go, oh yes, man, Modigliani, whatever it is.
Yeah, and it basically says two things. First of all, that the value of a business is not dependent upon how it's financed, i.e. between equity and debt, but also that you should be indifferent between income and capital.
Yeah.
But actually, it's one of these occasions where, the theory and practice somewhat diverge. So although there is theoretically no difference between income and capital, in actual fact, behaviourally, and we're all human after all, there does seem to be, because the need to pay a dividend means that you tend to be more conservative in the way you manage the business. It means you're more careful with the capital which you use thereafter. It means that you probably don't go off and do huge acquisitions with capital that you are less careful about. It means that you've probably it's an indicator of a stable and predictable and resilient business. And so, although, yes, just like there's lots of theories which work in theory, but they don't actually work in practice, this is one of them.
And listen, we know that matters, is because if a company has built up a reputation of paying a dividend and then suddenly stops paying a dividend, the reaction is usually quite catastrophic.
Which is why I say that the level of a dividend, at least if you have a decent management team, is indicative of what the sustainable earnings number of that business is, because management teams are keen not to cut, and therefore ought to put it at a level they think can be sustainable in the long term.
Now let's go back to my second thing, dividend reinvestment. That matters as well, doesn't it?
Yeah, so your Warren Buffett point I always think is interesting, because I'm a huge Warren Buffett acolyte. I know many investors are. But he himself loves dividends. So from his underlying subsidiaries, he draws all the capital out to Berkshire Hathaway, and then he allocates them. It's just at the corporate level, at the top co, if you like, he doesn't distribute dividends because he wants to compound for himself and for his shareholders. So he recognises that having dividends being divvied up to the centre actually is a sensible thing, because he thinks he can allocate capital better than the underlying management teams. And similarly, for investors, it may not be such an imprudent thing to do to have some of your capital returning to you in a regular way each year, which you can then spend on day-to-day expenditure and allow the rest to compound. Now, just to finish on that, years ago, the difference between income-bearing stocks and non-income-bearing stocks wasn't very much. In fact, I was pretty indifferent as to whether or not I was compared against an income benchmark or a capital benchmark or whatever. Recently, that has changed somewhat because you've had this particular dynamic where these particularly profitable, large US technology companies, which don't tend to pay a dividend, have become quite dominant. Now, and that has made people think, well, therefore income investing doesn't have a place anymore. I would argue that it's a relatively recent phenomena. Income and capital division thereof goes back to the Crusades, which is much longer. It tends to be that these technology companies at some point pay a dividend, and actually that's taken
and some of them have.
Microsoft being a good example, Apple being a good example. And when they do, their share prices actually do pretty well.
Yeah.
Because management teams think they're becoming perhaps more careful with the capital that they have. So in my experience, income investing becomes into and out of favour depending on what recent returns have been. And the stronger recent returns have been, the less in favour income investing is. And if we do move into a more difficult period, and we can talk about that in markets, after all, we have interest rates have gone up more quickly and further than they have for 40 years.
Yeah.
And yet equity markets are pretty fully valued on many long-term measures.
Yeah.
If we do move into a more difficult time, and I would argue that's very probable, very possible, well then having
nice,
a degree
reliable dividend.
Might be exactly what you require for a proportion of your income, of your capital.
And it's important to say as well, I was busily bad-mouthing academics, but when academics do look at things like total shareholder returns, there's a term you sometimes hear, total shareholder returns, which is capital gains and dividend in total. And they chart them by decades. To your point, there are some decades dividends matter enormously, and their dividend reinvestment matters. So
Absolutely
if you
right.
add them up together, the capital gain, which quite often is not as big as you think it is, then the dividend, and then the dividend reinvested and the growth of the dividend. Yep. So you add them all up together. That can be, in some decades, a very substantial proportion of the total return. But in other decades, like more recently, lesser.
Exactly right.
And it moves in cycles.
It absolutely moves in cycles. And I would argue that you could say we are right at the end of a very long cycle.
Yeah.
And what I mean by that is arguably we haven't really had an orthodox economic cycle for 25 years. COVID was COVID. The global financial crisis in 2008-9 was really a housing and US banking issue. A classic orthodox cycle whereby you have a bit too much inflation, you put up interest rates, you slow the economy, that often leads to a credit cycle, that leads to problems in the economy, and then we all move on. We haven't seen that for 25 years. And arguably, it may be that it's become so unfamiliar that people have forgotten what it looks like. If I'm right, and that may be what is exactly what's about to unfold, after all, interest rates work with a so-called long and variable lag in the economy. The effects of interest rate rises usually become apparent somewhere between 12 and 18 months after the last interest rate rise. Yep. The last interest rate rise in the States was July 2023. So we're comfortably still in that window where the effect of that rise in the cost of capital, those interest rates, may yet still be seen.
And we're seeing evidence of slowing down in America already.
Right. Yeah. And so if that's the case, it may well be for the next decade that the proportion you get from income and a more conservative approach to investing, which is descriptive of how we at Troy do it, may be exactly what you require for a proportion of your capital.
And by the way, just on a narrow point, another term you might often hear is buybacks, because what we're talking about dividends is a return of capital.
Indeed.
And some Americans, and actually some Brits as well, like returning capital or buyback. Are you agnostic on that? What's your view on buybacks? Because effectively they're giving the money back to shareholders, but they're just doing it by buying their shares.
Yeah, well, it depends upon the valuation of the shares, because a buyback at a cheap valuation is accretive to existing shareholders, but if it's done at the wrong time, it can be very costly. Be that as it may, we don't equate buybacks with dividends in the sense that we are trying to produce a return balance between capital and income.
Yeah.
And by income, we mean capital that you get, cash you get in your hand and you can pay your gas bill with. Whereas buybacks just alter the capital structure of the business. So although they're if companies are buying back stock with excess capital when the shares are cheap, tick. But you shouldn't be it shouldn't be considered as part of the income that you're generating for your clients.
And also we should not ignore there are tax advantages and possibly, I mean, I've heard this said, advantages for the executives concerned. But moving on.
Just on that, there's a difference between options and restricted stock.
Yeah, that's true.
Because if you have options, you're not entitled for dividend, whereas if you have restricted stock, you are, or at least at some point in the future. Yeah. And actually, there was a time back in the late 2000s when options were the thing. And that doesn't necessarily encourage sound capital allocation. You just want to just grow the company very quickly. Whereas if you are going to be entitled to dividend at some point, then you might be more sensible about the dividend policy of the company. And so there has been there was a bit of a cultural shift. I'm not exactly sure it's followed through as much as one would hope, but there are there's a difference between those two things.
Two other terms we hear bandied around is that because you like companies that pay a dividend, which are likely to be more mature companies. I.e. they're not likely to be a brand spanking new tech IPO. Therefore, you could end up in one or two kinds of companies. You could end up in what they call a quality stock, and that's not a chocolate box thing. That's quality companies.
Uh-huh.
And explain maybe what that means. Do you end up investing in quality companies? And the other thing is, how do you avoid the other trap I think you might find yourself in is a value trap, which is quite often nice, big, generous dividend yielding stocks are generous yielding because their share price has gone down. So they could be dangerous value traps. So how do you mitigate? How do you manage around those two are kind of opposites, really? Quality shouldn't end up like a value trap, hopefully.
Well, so there's three things in that. There's growth versus income. There's quality, and then there's value traps. And I'll try and take each three and remind me if I don't quite get them all. But the first point is growth investing is all the rage at the moment. You know, why would you do anything but invest in the fastest growing businesses you can because you get the best return? And that does certain periods in the market, that does very well. The problem is that investors have a tendency to overpay for growth. Because growth companies tend to have the whizziest product and the most exciting new thing and the sort of shiniest mousetrap. But it's not how fast a company grows, it's how fast a company grows relative to expectations that ultimately decides the return that an investor will receive. And because they're so exciting, investors tend to overpay. Now, I'm not saying that there are some companies that we could cite today that may be overvalued relative to their future growth prospects, but I bet you there are. So it doesn't mean that growth investing doesn't have a place. It just means you should be aware that it has a slightly higher risk profile than potentially income investing. So that's point one. Point two is that income investing and quality are absolutely not, we view them as synonymous. They don't necessarily need to be. You can build an income portfolio and buy low quality businesses. Now, what do I mean by quality? Quality to us, and at Troy we put quality before anything, is high returns on capital employed.
Right.
I.e., it's the return you generate after you've paid all other your stakeholders in a business, and is the best single measure of the profitability, the overall economic value that a business is generating. And we want to be investing in businesses that have high returns on capital. We also want to be investing in businesses that have high returns that are sustainable over time. And the only way you're able to do that really in a capitalist economy is by having certain attributes in a business which allow you to earn high returns without being worn away by your competitors. And they tend to be things like brands or distribution or being the lowest cost or having patents or any number of different things. But you need to identify what they are, and you need to identify whether they're sustainable, and then you can have a good idea of why they earn decent returns and why they're likely to continue to do so.
So what would the classic quality stock be?
Probably
in your portfolio.
Yeah, I suppose in our portfolio, something like a Diageo.
Yeah. Okay.
So it's the world's largest spirits business. Spirits is a fantastic category. People are very loyal to the spirits that they drink. When you go into a pub, you don't really care what beer you drink. You care a lot about what spirit you drink. People are drinking less, but better, i.e. they're being healthier, but they are trying, they're happier to spend a bit more on what they drink. It's an affordable treat. People are very loyal to what they do. And this affordable treat and this drinking less but better means that the spirits businesses are being able to premiumize and encourage people to pay more for their drink. So put all that together, they all also have fantastic distribution, fantastic brands, and they generate a fantastic return on capital as a result. So that to us is a quality business. And there's only a certain number of slots on a bar. If you go back into a bar in 50 years' time, I bet you that most of the spirits that you see today will be the same ones.
Yeah. How do you avoid the value traps then? So again, it's very dividends attractive to some people, and there's lots of stocks paying really juicy dividends out there. Is that always because they're value traps? Because they've basically their share price has gone down and the dividend yield's head steady. And how do you avoid them?
Well, first of all, you should be clear about what you're trying to buy. And at Troy, we try and restrict our purchases and our efforts to particular sectors and particular businesses that have particular attributes, as I described, and Diageo is a very good example of that. Conversely, there are lots of sectors whereby it's actually quite difficult to know what the cash flows from those businesses are going to be like on a 5, 7, 10-year view. Given very low turnover we have in our portfolios, that's the time scale over which we're considering an investment. So something like retail or telecommunications or utilities, they're either going to disrupt themselves or be disrupted by somebody else, or have as we green the economy, they would themselves be disrupted by that. All of that means that it's very hard to predict what the cash flow is going to be like. So even though they have an income, we would largely avoid them. So number one, be clear about what it is you're trying to buy and have a long-term time frame. And then the second thing is, ultimately, running an income fund, to my mind, is all about buying really good businesses when they're out of favour. Now, at some point, all businesses have a difficult time. Diageo is actually a very good example. So as we all know, in COVID, there was a bit of a boom, because everyone was at home and there wasn't much else going on. And that's turned into a bit of a mini bust, whereby people have got, everybody's got some drinks in their drink cabinet and they don't need to buy another bottle today. And therefore, Diageo's had a bit too much inventory, and at the same time, the consumer's under a bit of pressure because of the cost of living crisis. And so that's also pressing down on demand. And then thirdly, the supply chains or distribution chains in America are particularly complicated because they're a hangover from prohibition. And so so all of that put together means if you've got inconsistent demand and inventory levels, then you get a sort of bullwhip effect, and it can put a downward pressure on earnings and cash flow. Now, ultimately, that's a short-term thing in our view, and it's giving us an opportunity to invest in a company like that at a very attractive valuation on a 10-year view. So the way you avoid value traps is two ways, really. It's first of all, concentrate on what matters, i.e. it's not so much what short-term trading and numbers is about. It's about what the long-term competitive advantages of those businesses are. Second thing is then, what are you paying for it? So I suppose there's three. And the third is make sure that you've got a balance sheet that's sound. Because what really carries you out and what turns you into a cheap share that gets problematic is if things don't improve in the short term and the business is over-levered, then you can get a dramatic reduction in the cost or in the value of your equity. So it's a question of quality, value, balance sheet.
And the great example of that, I suppose, with everybody got very excited about mobile phone businesses and telecoms businesses, and they've been paying quite juicy dividends for a very long time, but they've also been racking up their debt.
Well, one of the points about quality is that what you want to be doing is investing in business have very relatively limited capital requirements. You don't have to put up lots of money to make money.
Yeah.
The best businesses are those that are, for whatever reason, they have intellectual capital or they have clever designs, or, Apple's a good example. Apple doesn't actually manufacture most of what they do. They just provide this sort of clever stuff.
They hardly manufacture anything.
Exactly. So they have very high returns and quite limited capital requirements. But if you do that, what that means is that you have sufficient capital to be able to invest in your business, to be able to entrench your competitive advantages and pay a dividend. That's why avoiding capital-heavy businesses makes sense. And your example, so telcos were thought to be a wonderful business at some point. They've always been very, very capitally intensive because you have to build the networks.
Yeah. And keep updating the networks.
Well, not just that, but also the pricing power is not great because the regulator doesn't want you to be able to price. So those two together, ultimately, long-term, don't make them very good businesses, even though they're at the centre of an amazing revolution.
Yeah.
So that's why quality has to be first.
Let's finish off with a couple of last questions. I've heard a lot about brands, about quality stocks. Could you end up having a bit of a sector bias where you end up, and this is a big issue for all fund managers, is that because of their particular strategy, they can end up being very focused on a particular type of stock. At the moment, if you're a growth investor, you're probably jam-packed full of tech stocks. Could you not end up being having a portfolio of jam-packed full of brand names?
Well, absolutely. But well, first of all, on the growth thing, it is quite interesting where we've reached a point in the markets where it appears to me that most income investors are total return investors. Total return investors become growth investors. Growth investors become tech investors. We're quite out there in terms of the risk profile, and that often tells you something. We've got a high degree of concentration in markets and pretty full valuations.
Yeah.
So that's of interest. And what was the second part of your question?
Yeah, so is the issue you become very focused on brands?
Yes. So at Troy, as I mentioned, we try and focus on particular sectors and particular businesses. So we have a conscious sector bias in the sense that we want to be investing in particular sectors and particular companies because we think they're the ones, and brands is a good example, that have competitive advantages that allow them to generate decent returns. Similarly, there are lots of areas, as I mentioned, like telecommunications, like utilities, but also bulk chemicals or mining, and these sort of businesses which we think are cyclical and capital intensive.
Presumably energy as well.
Energy, a good example. We wouldn't, because they're capital intensive and cyclical. They have their day in the sun at particular points in the cycle, but over time, their returns on capital are quite poor. So we are quite concentrated in particular sectors and particular businesses. Now, the upside to that is I think investors got a clear idea of what we're doing, and we've got a very clear idea of the sort of businesses we want to buy. The downside is there are times when we look very different to the market and we perform very differently to the market, and now is one of those times. Now, our view is that I think most investors understand that. We'd like to think. We're very clear about what we're doing. And we're a stable, privately owned boutique, which means that we can look
the fund management company.
We, the fund management company, Troy. So we can look to the long term and withstand these periods when we diverge materially from the benchmark, uncomfortable though it may be. So yes, we do consciously have a sector bias, and we think that's the right way to be.
As a matter of interest, do you end up liking luxury stocks?
We do like luxury stocks. We don't actually have luxury stocks in the portfolio at the moment because we felt that they've got too expensive.
Okay.
But the fascinating thing about luxury stocks is that the margin structure of the business is baked in the business model because people buy luxury effectively to show off.
Yeah.
And so the fact that it's expensive is seen as a good thing, not a
You're
bad
about to
thing,
say, yes.
which means the margin is by definition high.
Yeah.
So they're wonderful businesses, and they've been in a fantastic sweet spot because, of course, the Chinese consumers come from nowhere and has been a very strong purchaser of all these kind of things. Arguably, that is cyclically coming to an end.
Well, I think it
maybe not structurally coming to an end. Yeah. And if we are moving into a more difficult time, investing in businesses where the products are very fully valued, or very expensive, they might come down to a level where we're able to invest.
Useless fact: top 3 stocks in the French CAC 40 are actually luxury stocks.
Yeah,
L'Oreal, LVMH.
Indeed.
Anyway, last question. We've started off talking a bit about income-orientated investors who tend to maybe perhaps be a little. I'm generalising here. Older. Mm-hmm. They don't want to see the destruction of their capital. Does your strategy work for younger investors? And secondly, should younger investors who can ride volatility, should they just really focus more just on growth?
Well, it's always,
and is it an either or?
It's always horses for courses. I mean, I think we are particularly attracted to older people because not only are they requiring income, but they should be avoiding drawdowns, as I mentioned. But Troy thinks, generally speaking, that if you avoid steep drawdowns, then you have more capital to compound over time. Because you all know that if the stock halves, you have to go back up 100% to make up the shortfall. So for younger investors, but perhaps you have a lower risk tolerance, who don't want. I mean, you talk to some investors and they're like, I just don't want my money to go down by half. I just don't want that.
Yeah.
And therefore, they want to compound capital over a long period of time. I want to do it in a relatively conservative way.
And interesting enough, I remember seeing some research from Nest, which is the auto enrollment people, and they did some research where they talked to mid-20-somethings, and they found that actually when mid-20-somethings who didn't know anything about the stock market had big losses, it was a permanent scarring effect.
Indeed, as we all know, the loss aversion, losses are felt much more keenly than gains internally. And therefore, if you're on a strategy, the most important thing with investment strategy long-term is to be able to stick to it when times are tough.
Yeah.
And therefore, you have to, in a sense, know yourself. And you have to invest in a way that that you can get through the tough times and not panic and sell. And if having a strategy which has slightly lower drawdown, slightly lower volatility, a balanced return between income and capital is a way in which you can do that, well, then that might well be an appropriate thing for both older but also younger people. And the way we're setting our stall is like this. It's a very interesting time in markets because the fixed income markets, i.e. bond markets, gilt markets, have changed to the degree which you can get 5% now at the short end of the bond market, i.e. for 2 years, say. And that's all very well and good, not great for mortgage holders, but terrific for savers. The first time in a very long time you can get a genuine return on your cash. But you're probably going to have reinvestment risk at some point. What I mean by that is if interest rates do come down, and I don't think they'll go down to where they were, but they'll probably go down a bit at some point, then you need to reinvest that capital at a lower rate. And over the other side of the risk spectrum, you've got the Mag 7, NVIDIA, whatever you want to talk about, which has been absolutely fantastic. Mm-hmm. But the reality is you're going to face quite a big drawdown at some point. Now, you might be happy with that, but recognise that as possible. We set our stall out somewhere in the middle.
In the middle.
We're trying to produce a balance between income and capital, and we're trying to avoid those two extremes.
James Harries, that's absolutely brilliant. So hopefully you've had a kind of whistle-stop tour of the benefits of quality investing, quality stocks, of equity income strategies, and of the importance of dividends. And I'll absolutely reinforce that. I'm surprised by the amount of younger people I run into who arguably should be more adventurous, who are actually quite cautious. Actually, I think the great test of it is I reckon if you talk to quite a lot of younger people, they've probably lost a lot of money on things like Bitcoin and all that kind of stuff.
Right.
And they realise the volatility that this stuff can do. And actually something that's just a steady compounder can be very attractive.
Absolutely.
Anyway, thank you very much, James. Hope you've enjoyed this episode of Resilient Investor and listen to us for the next podcast.
Thanks very much indeed.
Pleasure.